While there are numerous advantages, don't get too relaxed with bond investing. Let's review the potential perils. The default risk is the chance that a bond issuer goes bankrupt and therefore has no funds to pay the interest or the principal. If a bond issuer has their credit rating downgraded, then typically the value of their existing bonds will drop. A bond investment might not keep up with inflation, depending on market conditions. A bond investment might forego an investment that is generating a better return. Additionally, if interest rates go up, then the value of a bond will drop. Let's review these potential risks in a little bit more detail. There have been cases where a bond issuer failed to make required interest payments on their bonds, or worse yet, failed to repay the principal at maturity. This is the risk of a default. The 2008 collapse of Lehman Brothers was one of the largest bankruptcies in the history of the United States. When the smoke cleared from that implosion, bondholders received a partial repayment of 20 to 30 cents on the dollar. With this in mind, it's critical to understand that bondholders face significant risks of a partial or complete loss of their investment when a corporation fails. And this is the reason that investors should do their homework about the financial condition of a bond issuer before investing in their bonds. Inflation risk is the probability that bond returns might not keep pace with rising prices. This risk particularly affects fixed income investments. If you own a bond now with a 3% coupon and inflation is running at 2%, then your real return is only 1%. So referencing this chart of inflation, before January 2021, interest rates were very low. Let's say, for example, an investor bought bonds about this time with a 2% coupon. Within 18 months, the inflation rate had skyrocketed to 9%. So if an investor had bought bonds under these conditions, with this timing, they would have experienced a negative real return for the next several months and years. When buying bonds, timing is important, just like stocks. Opportunity risk is the risk that a more attractive investment opportunity will arise that the bondholder cannot take advantage of due to their current bond investment. This table is a snapshot in time of the performance of the primary asset classes for 3 different time frames: 10-year, 2022, which was a bad year, and the most current time frame. The purpose of this chart is to illustrate the concept of opportunity cost, but it also is to point out that each individual must have an understanding of their own investment goals before making any investment decisions. Now, with this chart, I've referenced a fund representing each one of these asset categories: the stock market, gold, 3 different types of bonds, and real estate. So let's take a look at the chart, look at some of the takeaways. So over the long run, over the 10-year period, stocks have outperformed all asset classes. So during this time frame, if you had all of your money in bonds, you would be very disappointed. You missed out on quite a bit of return, quite a bit of performance from stocks. This is called the opportunity risk, the risk that you put all your money in bonds and you miss other opportunities. During this 2022 year, as you can see, everything really got hit pretty hard, except for gold. But the takeaway here is that bonds did not get hit as hard as stocks, and even worse, real estate. Now, during the 1 year, this is the most recent data for the past 12 months. Everything is doing quite well. Now, treasuries and bonds are up the least, but of course, they're also the safest, in particularly treasuries. And real estate has recovered quite nicely. So the point here is evaluate your opportunity risk when you start looking at bonds. But more importantly, each investor should understand where they are in their investment journey pertaining to their time horizon, their risk tolerance, and their overall investment objectives. Then make their investment decisions accordingly as to where to invest your funds. Let's talk about interest rate risk. If interest rates go up, then the value of your existing bond will go down. If you buy let's say $1,000 bond with a 4% interest rate, and a year later, similar bonds are now yielding 4.5%, then the value of your bond that you bought a year ago will have decreased in value because it pays less interest than the bonds that can now be purchased in the bond market. So let's see an illustration of this with this chart here. This is a chart of the 10-year bond. Its price in the blue and its interest rate in the red. As you can see, they are exactly inverse to each other. As bond prices go up, the interest rate that it pays is going down. Now, if you bought your bond over here and you're in a situation where it's dropping quite a bit, you might be tempted to go ahead and sell that bond. You would be selling it for a loss. Just remember, one of the characteristics of bonds is if you hold the bond to maturity, then you will receive back your initial investment, called the principal. It's just during that time, as the bond prices are going up and down, you have to be able to, ignore that and not worry about it and get to the maturity date. Then you get the full price of your bond back. Interest rate risk was one of the contributing factors for the failure of Silicon Valley Bank in 2023. The bank invested large amounts of their deposits into long-term bonds in 2021 and prior months when bond prices were very high and interest rates at historical lows. This move established significant interest rate risk for the bank. If you're the bank investment manager at this time, considering the upcoming economic landscape, you have to ask yourself, well, what happened to the value of these long-term bonds if interest rates started going up? In the wake of the COVID outbreak, the federal government flooded the economy with trillions of dollars, leading to rapidly expanding inflation. This pushed interest rates up, which caused bond prices to decrease in value. This chart of the Vanguard Bond Fund gives us an idea as to the magnitude of the decrease in the value of bonds post 2020. You can see here they peaked 2019, and then COVID was occurring at this time. Bond prices took a rapid and significant drop in value. Now just remember, as long as the bank did not have to sell their bonds, they would eventually get the full value of their principal invested back when the bonds matured. But remember, these are long-term bonds, some of them 10 and 20-year time frames. And Silicon Bank depositors began to be a little concerned about the bank's financial condition. So they began aggressively withdrawing their bank deposits. To meet this demand, SVB had to sell their long-term bonds for a loss. And this eventually resulted in them losing almost $2 billion. News of this and other factors spread quickly, and this led to the classic run on the bank. And SVB very quickly became insolvent and had to be shut down by the U.S. regulators. As potential bond investors, it is imperative that we have some idea of the upcoming interest rate landscape. From this chart of the 10-year U.S. Treasury interest rate, we can see that there's been some significant moves over the past year and a half. Here from April up to October of 2023, this represents a move or an increase of 55% in the interest rate that the 10-year yield pays. Now from this October to the next October, that represents a decrease of about 28%. These are huge moves. Now, we don't have to be experts on interest rates and Fed policy. We typically can pay attention to what is occurring with the economy and determine the most likely direction. But you can see from these big moves the importance of kind of getting a little bit of understanding of what's going to be going on going forward with interest rates. For example, today's environment is most likely one of decreasing rates, in that the Fed has already started lowering interest rates, and they've stated publicly that they plan to keep making more cuts in the coming months. And this is not a guarantee that rates will continue to drop. It's certainly not the case that rates will go straight down, because as you can see, as they've dropped to 2024, here lately they've been going back up. Now this could be a short-term phenomenon, but it shows, of course, that there's no guarantee that rates will continue to drop, and they certainly won't go straight down. Markets always move in waves. That's a very important point that we need to always remember. So even in a falling interest rate environment, the rate will move up at times over the short term. So as an example of the thought process that an investor might currently consider, if one believes that rates should generally keep moving lower, and considering that the stock market is at an all-time high, for those investors that want safety and income, this could be a decent time to consider investing in U.S. Treasuries while the rates are still relatively high. Bonds have evolved into one of the cornerstones of investing. They are complex instruments having a variety of benefits and risk. Bonds are the solid oak of the financial world. They're not always flashy, but they are a dependable classic that can anchor any portfolio. But even the strongest oak tree can topple in a storm. Whether you're a seasoned investor or just starting your investment journey, bonds present opportunities and challenges that are well worth exploring.